Tibrewal joins us. And while Pankaj would be smiling today, not because markets are volatile, because 3-4 months ago, Pankaj told us, "Bhai, mid caps are reaching a dangerous territory." Fund managers don't say that, but he came on board and he said that, look, mid and small cap stocks are unlikely to give you returns, which would be great. So Pankaj, now mid and small cap stocks have corrected. Every major mid cap sector has seen a 15 to 25% drawdown. If the starting point is 22nd of February 2022, are we in for now decent returns, given that a correction has already kicked in?
Hi, Nikunj. Good morning. I think it's still some time away before the stocks becomes extremely attractive. And the basic premise which we have been talking about is that in the near term, we believe that the earnings upgrade cycle has peaked out. And we have been saying this for last couple of months. And third quarter, we saw the glimpse. Fourth quarter, our sense is by listening to the commentaries by the management, by doing our channel checks, that the demand momentum is still very weak. And margin pressure is sustaining across different companies. And as a result, my sense is fourth quarter, as we move into that, still 45 days to go, my sense is that there could be earnings downgrade in the fourth quarter number as well. So once the street adjusts itself to the new reality on margins and top line growth, I think that will be the time to reassess the stocks at a new valuation point. And I think till that time, volatility will continue. We may have different distractions like Russia, Ukraine, China, Taiwan, or maybe US Fed at that point of time. And this volatility will give us enough opportunity to buy good quality franchises at our prices and valuations. So we still believe there's still some time away before we go and buy the market full-fledged.
When you say that markets, they need to perhaps correct, or we should spend some time so that there is consolidation, what is the basis for this criteria?
So there are a couple of things. One, I think this year is a year of transition from lower interest rates to higher interest rates, from excess liquidity to adequate liquidity, from early cycle to mid cycle, and from a very high earnings expectation to moderate earnings expectation. I think whenever you transit in a year and the year is of transition, you have to navigate it well, and that comes with a lot of volatility. Our base assumption is that the bull market continues, but the breadth of the market will become narrower as we have seen over the last couple of months. And that makes me believe that the easy money making, which has been there for last 2 years, is behind us. This year will be men versus boys. This year will be an extreme bottom-up stock picking, and people who can pick the right sectors and right themes probably will be the winners. The dispersion which I am seeing in the first 40 days globally across sector is crazy. Least to say, on one side, the return of oil gas majors are up 20 to 25%. On the other hand, the top IT companies or the top tech companies are down anywhere between 30 to 40%. So there is a dispersion of 50 to 60% taking place in two sectors in just 40 days time. Think about a public manager who is positioned on either of the sides, and the dispersion in returns could be very, very different. So I think this year we need to navigate it quite carefully. This year is a year of transition, of higher interest rates and tighter liquidity.
Bottom-up stories. What are you talking about?
So I think there are a few themes which we have been bullish on. I think the first one is on the entire revival of the investment cycle and the domestic facing economy stocks. And I think there you are seeing traction coming in. Order books are at all-time high, and that gives you a visibility for the next couple of years on the top line growth. And if you look into the past cycles, this is one sector in that once the top line growth comes in, the operating leverage could be very high in terms of margins. So I think there's a reasonable scope of margin surprise as we move into FY23 and FY24. And we believe that the capacity utilizations are running quite high across various traditional sectors. And that gives us a belief that capex cycle is beginning to revive after a decade or so. So that's one very interesting space where we believe that over the next couple of years, you will get decent opportunities. The second one is on financials. I think banks are, private sector banks especially, are looking very, very well poised in this cycle. And that's one space where valuations have corrected over the last 12 to 18 months. And that space is also looking good. The third space where we have been talking for more than a year now is the revival of residential real estate and the entire home improvement space around it. And we believe that that's a 3-4 year cycle beginning to start. And that space we are also liking it. And last but not the least, the export opportunity, where we believe that the demand momentum seems to be extremely strong as companies diversify their supply chains ex-China. And across sectors, when we are speaking to companies, whether it be light engineering goods, auto anchs, home improvement, specialty chemicals, everybody is saying that the demand momentum seems to be quite good. So I think that's the export opportunity which is there. And we need to go bottom up, select the leaders, select the companies with strong balance sheet and cash flows. And I think that this volatility will give us an opportunity to do that.
Pankaj, the other space also where off late a lot of froth has come out, of course, there are large cap sectors like IT, but the entire new age tech IPO space, your Nykas, Paytm, they've really been battered and bruised. Is this a pocket also that you're looking at? Maybe not from now, not from the near term, but a long haul perspective?
Yeah, so we have been very selective in the new age IPOs because we thought that valuations were something which we couldn't understand at that point of IPO. And the companies which we believe will do well, which have a good business design overlaid by a digital architecture. And I think there are few companies in that space in the new age tech world, which we believe have a long runway for growth. They have a right to win. And probably there is an inflection point coming in over the next couple of years where any new addition of subscribers will flow directly to the bottom line. So yes, maybe not all of them, but very selective in this space and trying to look out for the right price point where we believe that that can make us money over the next 3 to 5 years.
Morning, Pankaj. This is Nantara. So I was on the Kotak Mutual Fund website and I was going through the presentation for February 2022, where you've written that last 5 years, the Nifty manufacturing index has underperformed the Nifty 500. And the chances of an outperformance, the odds for that is 68%. Tell our viewers more about this, how exactly you're playing this theme and what would be part of the theme.
So the reason we have been positive on the entire revival of manufacturing are as follows. The first one is if you look at the balance sheet of corporate India, they are the best in 2 decades. And companies after companies, when we are interacting with them, they are saying that we are looking to deploy the cash flows back into the business. So after a long time, we believe that the animal spirits are coming back and people are looking to expand their operations. And balance sheet and cash flows are supporting that. That's the first starting point. The second one, if you look at, is that if you divide the gross capital formation into 3 parts, one is the government, the second is the private sector, and the third is real estate, which is household capex. The government has been doing its work for the last 4-5 years. In this budget also, we saw a very significant increase in the capex expenditure. Private has been silent, but as we believe, balance sheet cash flows, plus the PLI opportunity and the China Plus strategy is helping them go and expand their operations. And many sectors, Nantara, whether it be electronics, whether it be API, chemicals, pharma, the entire ecosystem around the green energy, I think you will see massive amount of investments coming in those areas. And companies after companies, when we are speaking to them, they are saying that the entire ecosystem around them has started to build around. And probably that may take 2, 3, 5 years, but we will see that momentum gaining. So that's the private sector. And the third part is the household capex, which has been subdued for almost 7, 8 years, which is real estate. And that's where we are seeing early signs of revival there across the top 10 metros. The unsold inventory is at 8-year low. We have started to see price uptick also happen. And probably the launch cycle, which determines more of GDP growth, will start in our view after 6 to 8 months. So when you combine these three portions, the government, the private, and the household capex, I think the manufacturing sector and the investment cycle looks to be poised for a revival. So that's the point we are trying to come across, that it has been wolf calling for a long time. Probably the wolf is there this time around, is our view.
There's one thing about what to buy in the recent fall, and the other point is also what to avoid, because you've got to be prudent there as well. So what are the spaces that you're completely advising people to stay aloof from?
So absolutely. I think in investments, what not to do is more important than what to do. And if you're clear of what you will not do, the list of things to do becomes shorter, and one will be surprised with the outcomes. In this market, and as an investment philosophy, we have stayed away from leveraged companies, ex-financial. We always believe that look into the history rather than looking into the future, and avoid companies which can't generate return on capital or return on equity above cost of capital for a considerable period of time. Stay away from companies where there's huge cyclicality across the board, and they don't have pricing power. And if you can, stay away from companies which have very, very high valuation and low floating stock, I think that will be another space. So I think these are the 3-4 things which we will advise investors to avoid from, because things are very volatile. This year will be a year of volatility. So please follow basic investment principles while selecting stock sectors or funds. And I think that will help you navigate this volatility quite well.
Pankaj, another space that you have been saying that you're bullish on, and while I was researching, what I came across is consumer durables. Why do you like the consumer durable story so much right now?
So we believe that on the consumer durable side, the basic thought process is that as you transit from a $2 to $5 trillion economy, and as you move ahead of the break-even point of $2,000 per capita GDP, the incremental money spent on food or food staples starts to come down, and discretionary expenditure starts to move up. And we believe that appliances in India is a very underpenetrated category. You took it ACs, for example. Air conditioning as a category has grown at double digits, equal to almost what paints have done. And we believe that now ACs are no longer a luxury, it's a necessity at every house, at every office. And with real estate cycle picking up, I think demand for consumer durables will see a very sharp upturn. And there we believe the entire consumer durable category, small appliances, are very well positioned. And the runway for growth over the next 3-5 years seems to be very, very strong. However, we need to be very selective in the companies we approach in this space, who have strong distribution, strong brand power, innovation capability, and the ability to also export to the world market from a cost competitiveness perspective. And the companies which are ticking those boxes are part of our portfolio. But from a 3-5 year runway for growth, I think the sector is very well poised, and we are positive on from a mid and small cap perspective in this sector.
Okay, so watch out for mid-cap and small-cap space when it comes to consumer durables in particular. Pankaj Tibrewal, it's always a pleasure having you on the channel. Thank you so much for joining us live today to help us understand the market construct and, of course, the big themes Kotak Mutual Fund is betting on.